You guys have any more comments, or should we move to Brennan?
We're good.
Okay, great. Brennan's going to take a look at Atlas Engineered Products. We've interviewed management of this company in the past. We've also talked about them on the podcast. Interesting business. Have continued to kind of not stay away from it, but just monitor it from the sidelines to see if there is an inflection point in the business. And right now, Brendan's going to take a look at with the share price down roughly 40 plus. I think it's 40+% on the year. See if there is some value today.
Yeah. So I thought that I would do an update on Atlas Engineered Products, as I'm currently writing an article on what Canadian industries may provide pockets of strength to investors under Prime Minister Carney's Liberal platform. And Atlas could be a name to benefit from increased residential infrastructure spending. So I thought that I would touch on the business, but keep an eye out for that article, as it will address other sectors as well. And the poll on YouTube that we published this week will pose the question of which Canadian industries could benefit the most from the new Prime Minister's policies. So please vote in that as well. So to get into it, Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of 75 cents and about a $52 million market cap. And they design, manufacture, and sell engineered roof trusses, floor trusses, and wall panels, and distribute engineered wood products for use by builders of residential and commercial wood-framed buildings. Like Ryan said, we've covered the stock on the podcast several times, with Ryan covering them last in December of 2024. So considering they posted their Q4 2024 financial results on April 25th, which was just a couple weeks ago, while the stock continues to trade lower, let's dig into the numbers here. So jumping right into the financials, Q4 of 2024. Revenue increased 6% to $15.1 million due to a number of large multifamily projects starting in the quarter, and sales increased due to projects moving forward as the interest rates had been declining, which was starting to result in an increase in orders. But there was also a large multifamily project which began in the quarter as well. Gross margin for the 3 months ended December 31st, 2024 was 24%, which is higher than the gross margin of 21% for Q4 of 2023. And the gross margins increased due to the project pricing for materials that were obtained for the large multifamily job. Adjusted EBITDA was down 45% to $2.1 million, which is an adjusted EBITDA margin of about 14% compared to 27% for Q4 of 2023. And these decreases were mainly due to the decrease in net income, resulting from a more competitive market for sales and increased costs related to future sales and robotic plans that required significant expansion in sales teams, management, and support staff. Now, this similar case with net loss here for the quarter was a loss of $212,000 or 1 cent per share, compared to a gain of $519,000 or 1 cent per share in Q4 of 2023. And again, the decline is related to the impacts that I noted for above the adjusted EBITDA. But I'll also note the company recognized an impairment loss of $1.5 million due to the write-off of the vendor deposit with its previous automation partner, House of Design. And the deposit was deemed uncertain as to the recoverability due to the vendor's lack of communication and closing of the business. But the company, as in Atlas, has begun legal proceeding to try to recoup some of the money. So there could potentially be a benefit in a future period if they do recoup some of this money. But overall, it is a bad look for Atlas. Realistically, they should be doing more research into, who they're making deposits with and if these companies can actually deliver. Now, the balance sheet remains healthy with $13.2 million in cash, with $24.6 million in debt and leases, providing a net debt position of about $11.4 million. And the company has a trailing net debt to EBITDA multiple of about 1.34 times, which is reasonable. And as I noted last time I covered the stock, they did do a private placement last spring to help bolster the balance sheet while they make capital expansions through robotics. So you can see the issued shares increasing to about 70 million now. And just looking at the outlook, I won't read this whole thing, but management indicates that they continue to work on improved operating utilization and technology to enhance the company's performance. 2024 was a more competitive year as interest rates had risen, but was beginning to experience an increase in quoting by the end of the year as interest rates were declining. Now, the company anticipates 2025 will continue to be a more competitive market despite the interest rate reductions due to the current political landscape, and implemented tariffs are anticipated to impact businesses and consumers across North America. The company does continue to assess M&A opportunities like its acquisition of LCF in 2023 and announced that another one had completed the due diligence phase with anticipated closing in early spring of 2025. Looking at the forward valuations on the company, last time when Ryan covered the stock at when it was trading at $1.22 back in December of 2024, analysts were expecting about 5 cents in adjusted earnings per share for fiscal year 2025, which equated to a forward PE multiple of about 23 times. But following the Q4 results posted in April, analysts have been dragging these EPS estimates lower from 5 cents now down to about 4 cents as at the time of recording this podcast. And the anticipated inflection year of fiscal year 2026, when Atlas brings on its robotics in a more meaningful fashion, down from a whopping 14 cents consensus back in December of 2024, now down to just 5 cents for the year, equating to a forward PE of 14.7 times. So these revisions are likely taking into account the overall competitive quoting environment, tariff uncertainty, and the delays of the robotics at LCF and High Tech, which Ryan briefly mentioned in when we did them on the podcast last in December. So to conclude here, in reference to Atlas, we believe that it is an intriguing business, and I do like the potential play on the housing sector in Canada, given the lack of supply. But it does remain a competitive market, as indicated by management's outlook, and tariffs pose a risk for the housing market in Canada and the overall Canadian economy. Fundamentally, the business does still remain pricey on trailing numbers, as it's got negative EPS for fiscal year 2024. But if over the next couple of years it can fulfill its capacity enhancements and lower costs, the forward financials and valuation multiples appear much better. But it's starting to become harder to trust these estimates that are out there, as we've seen continual revisions lower. There's tariff uncertainty. And costs are elevated as well, as they've been investing in their sales team. So at this point, I remain hesitant at this time. The business is investing for capacity in the face of potential headwinds, including those tariffs. They also recorded that impairment of $1.5 million with a robotics vendor, which is not a good look. And realistically, I wouldn't say that the business is necessarily cheap, even after its recent decline in price. So overall, I think that Atlas is intriguing, but it just makes sense, but it makes sense to us, why the stock has been declining, and we continue to monitor the business at this time. And I'd like to say that, the drop in the share price, it just really doesn't come as a huge surprise. The stock price was continuing to trend higher in 2024, despite weaker earnings and headwinds in the Canadian housing sector, which I wrote back in October 2024. The stock continuing to hold its ground at that time was likely due to the enthusiasm around the business robotics investments, and that general significant inflection in profitability forecasted a few years out, which we're seeing maybe be even pushed further into 2027 or 2028, as they bring on these robotics investments. And last but not least, we just for disclosure, we do not own or have a relationship with the company.
Yeah, I think it's a good summary on the business. I mean, Brennan had said, 2023, they had better numbers in terms of earnings, although down from peak earnings in the previous year. And then earnings through 2024 continued to be very spotty, like
Mhm.
a cent in a quarter, then a negative quarter, not high earnings in that year. And despite this, the share price moved steadily higher in 2024 and even to start 2025. The valuations on a trailing basis, and given the fact that, you're facing uh, tougher conditions in the Canadian market in the near term didn't seem to make sense to us. It's not that we don't like the business or like the long-term plan here, but the valuations were out of sync with the current environment. And for a cyclical business, this is a cyclical business. You're not going to uh, I mean, it's not really an argument to be made for a construction-based business such as this. It is a cyclical business. You've also seen this company fund itself through issuing shares. If you go back to, I think it's
Yeah.
2017, 17.3 million shares out today, 65 fully diluted in the range of 70 million. So that's, significant increase in shares, and you're fighting against that to produce EPS. So, you have to have significantly higher revenues. And again, analysts, even the analysts who are on the side of the business that would love this company to do financings with them, are bringing down their earnings estimates to the point where, this year you're looking at a loss of 2 cents plus per share. And then maybe, in an optimistic scenario in 2024, 2 cents positive, 2 to 5 cents. I think Brennan
Yeah.
brought up the earnings, but those have been coming down. If it was 2 cents and you put it at stocks, 75 cents today?
Correct.
That's a high PE looking 2 years out.
Yeah.
So again, this is a business we follow. Perhaps it could be a recommendation at some point, but we'd have to see a turn, a catalyst here, and then we may get it at a cheaper price. Again,
Yeah.
interviewed management, they seemed reasonable, but are the valuations where we like to see to give us the margin of safety that we want, particularly in a company like this? Not at this stage, and we continue to monitor it.
Yeah, exactly. Like I think, and that's the thing where we're trying to actually see a little bit of a confirmation of the inflection in the numbers, before we're going to
Mhm.
put our hard-earned dollars. And again, you can come down to like, the point where people always say, "Oh, but you're missing out on the opportunity getting in early." Well, look if someone was getting in, at $1.40. I was even covering the stock. Just there's risk that there's delays or costs go up, et cetera, et cetera, et cetera. It's cyclical, as Ryan had mentioned. The risk isn't it's not gone. It's a risky name in the space. And clearly with these EPS revisions downward, you know it's the numbers aren't confirming that these robotics investments and the inflection in earnings have are taking place, I guess, at this point. Like, we need to wait for that to see.
Yeah, and there's always competition for your dollars. Do we find another company that's trading at more reasonable price with growth ahead of it? I mean, I'll give you an example. We had a company in our coverage go up 15, 16% today alone. Somebody recommended them on BNN. This is a company we recommended 10 months ago at like 80 cents, 78 cents, and it trades at $2 today. Well, its current trailing PE is below 10, and we expect growth this year. So you put that PE towards Atlas. Atlas is 35 times a year out earnings, not just this year, like a year, like 18 months forward. So you're paying a premium price relative. You're also in a less cyclical industry in the business that I'm talking about. So there's always what else can we do with our dollars? And if we can find a company, and again, that company is now probably up 160% over the past 10 months, and it still trades at more reasonable valuations, has a better balance sheet,
Yeah.
and actually has growth forecasted for this year. So, I
Mhm.
mean, you're always competing with another small cap. That small cap would get our dollars over this business right now. Doesn't mean that Atlas is a terrible business. We just have to see what is a better place to put our capital. And there are other places where we see better valuations, more certainty of growth, less cyclical industry. So that's where we put our dollars right now.